Hello everyone and welcome. In this video we are going to be taking a close look at LoopUp Plc, a cloud communications business listed on the London Stock Exchange, and whether or not this could be a growth share worth adding to your portfolio in 2021. This is another small cap stock, with a current market cap of around £43 million. Small cap stocks can offer value to private investors not found in larger companies, by virtue of the fact that there is little coverage of these stocks, and therefore arbitrage opportunities are more likely to arise. With that in mind, let's get started. At the Personal Finance Institute, our mission is to bring financial literacy to you, so that you can plan your financial future. If you are finding our content useful, informative, and you'd like to see more, please do like, share, and subscribe. LoopUp Plc is a cloud communications business, based in the UK, and headquartered in London. The company was established in 2003, provides premium video conferencing and communication software, and can be defined as a software-as-a-service company. The company attempts to differentiate itself from competitors, such as Zoom, by supplying a higher quality service, with a focus on reliability, and it does this by using direct routing voice communications which are more reliable than standard internet connection-based solutions. The revenue earned by the company can be broadly split into two distinct chunks: professional services revenue, and non-professional services revenue, with professional services comprising law firms, banks, and other high-end business clients who use the product for business-related purposes. A core part of the company's current strategy is to focus on professional services revenue, and although this is not through choice, we'll see that this segment forms a key part of the bull case for the company. This is because, whilst competition is fierce in standard video conferencing, with the likes of Zoom and Microsoft Teams dominating the market, the appeal of high reliability best-in-class solutions is much more well-suited to high-end professional services clients, where quality of communication is paramount. A good place to start when deciding whether or not a company is worth investing in, is to research the products on offer to see if they offer products that people want. As we can see from these review ratings, which are available from softwareadvice.com, the LoopUp Plc product offering is highly rated, though there is little to choose between it and its competitors according to user ratings. The share price history of the company is up and down, to say the least. In the last few years prior to 2020, the company was expected to grow quickly, which explains the share price rise to over £4.50 per share. This expectation was not met, with growth being slower than expected, with the share price collapsing to as low as 50p per share. In early 2020 the COVID-19 pandemic began, and a key characteristic in the pandemic was the rise in remote working. This in turn was expected to result in a rise in demand for video conferencing solutions as a matter of necessity, and on this expectation, the share price rose again. This was bolstered by strong half-year results for the company. In early November 2020 news of the first effective vaccines was announced, which negatively affected the share price, and this was further compounded when in late November, LoopUp provided a trading update which was well behind expectations, and in particular with non-PS revenue declining 32% since H1. In terms of financials, we can see that revenue has grown over the last few years, but profitability has been a challenge, most notably with pre-tax profit lingering around the break-even point. We do note, however, that if we exclude amortization of acquired intangibles and restructuring costs, which are extraordinary in nature, the underlying profit of the company has remained just about above zero. The key takeaway from the last 4 years of financials is the sharp reversal of revenue mix between PS and non-PS revenue in 2020, which now forms a key part of the strategy moving forward. The financials in 2020 may seem highly promising, with underlying pre-tax profits of £9.2 million, which has been estimated according to management guidance from November 2020. However, we note that profit earned by the company in 2020 is highly skewed towards H1. In the June 2020 half-year report, the company released promising results with net profit before tax of £7.5 million, and an encouraging pipeline of new potential contracts worth £50 million. However, in November 2020, management notified investors in a trading update that it expected revenue in non-PS revenue to decline by 32% in H2, with revenue in PS not increasing fast enough to offset this, with an expected increase of just 6%. This has likely been caused by heavy competition in non-PS revenue, with rival companies such as Zoom dominating. In this area, the company does not have a differentiated product offering, which it does in PS revenue, and therefore it hasn't been able to compete effectively in an environment where remote communication tools are a priority for businesses and consumers. This has led to an estimated net loss before tax of £0.3 million in H2, which has been the primary driver of the collapse in share price. The one piece of good news for the business is that the pipeline of potential contracts has increased 68% since the half year to £84 million, and how well the company is able to convert this into revenue will be a key determining factor in the company's ability to succeed. The other main threat to the company is a further shift in working patterns. With the COVID-19 vaccine being rolled out in early 2021, there is a risk that working patterns will shift away from remote working when COVID-19 restrictions are eased across the world, resulting in reduced demand for the product. Profitability has been shaky for the company, under pressure from competitors such as Zoom who have dominated the market. So balance sheet resilience is important so that we understand how well the company may be able to endure future downturns. As at June 2020, the company held cash of £8 million, up from £3 million at the 31st of December 2019. Moreover, the company had net current assets of £10 million as at June 2020, and this has increased from £3 million in December 2019. This should provide further comfort that the company has sufficient liquidity to carry on its operations in the short term. Overall, there has not been much turnover in the management team in recent years, which is a good indicator of stability internally within the business. Notably, 5 of the 6 current members of the board were appointed in 2016, and several of them joined LoopUp years before this. In addition, as shown, the directors of the company own quite a substantial share of the company, with little selling activity taking place recently. This should give confidence to investors that the directors are fully invested in the company. In terms of valuation, this is always difficult to estimate, but particularly so when the potential scenarios of future performance are so varied. What we have done to give some idea as to where the valuation stands is to consider the forward-looking price-to-earnings ratio using 2021 earnings, under a number of different scenarios. In doing this, we have assumed that gross profit margins are maintained at 71%, and that operating costs remained fixed from 2020. We have also excluded any amortization associated with acquired intangibles as it is irrelevant to cash flow and future capital expenditure. The point of this exercise is that it shows us just how much the valuation depends on how well LoopUp can convert its pipeline for its cloud telephony products. Assuming a 0% conversion, with revenue remaining at the current ARR level of £34 million, LoopUp is unlikely to earn a profit, and in this scenario the price-to-earnings multiple does not apply. A 15% conversion results in a PE ratio of 11.3 times, and a 30% conversion results in a PE ratio of just 3.9 times. Considering the enterprise value to cash profits ratio for UK small-cap tech stocks is around 13.5 times on average, with LoopUp having little debt, this shows how much upside potential there could be for LoopUp, to say nothing of the high valuation multiples applied to the likes of Zoom and other successful software-as-a-service companies. Overall, we have seen that LoopUp Plc has benefited from the trend towards remote working, but it has not done well as one might have hoped, which is primarily because of high competition in the non-PS segment, where rivals such as Microsoft, Teams and Zoom have dominated. There is upside potential, however, with £84 million pipeline as at the end of November 2020, and ultimately the software as a service business model means that if LoopUp can grow into the non-PS market segment, there is the possibility of high profitability. The balance sheet position is strong for the time being, helped by the irregular cash inflow in 2020, which should provide some insulation from turbulence moving forward. In terms of key risks for the company, there is a risk that working patterns will revert back away from remote working, and that demand for LoopUp products will slow. If LoopUp cannot convert its current pipeline, it is unlikely to be profitable in the short run at least. The sector remains highly competitive, and as with other software products, there is a risk that rival technology solutions could render LoopUp obsolete. Overall, the stock carries a high level of risk. So, what do you think about LoopUp Plc? Tell us in the comments below. That's all for today, everyone. This video was brought to you by the Personal Finance Institute. Please do remember to like, share, and subscribe, and please do post any questions you have below and we'll be happy to answer them.